So Friday was a wild day of trading. Not really surprising given that it was options expiration, and you could just see options fingerprints all over the day's trading. We're looking at a chart of the futures, but if we take a look at the chart of the cash market, drop opening that getting down to around 56.20 or so, and then of course closing up here around 56.70 into the end of the day. Now this end of day movement was due to a very large buy imbalance, and that was, you can find these on X, just look under financial juice, and there was almost 4 billion to buy just in the S&P 500 names alone, and so that's a large buy imbalance. Anyone that pays attention to these on a regular basis, that's probably two to four times bigger than what we would see on a normal day. That was really largely responsible for this end of day ramp that we got. I mean, if you notice, it started right here at 3:50 in the afternoon. And so that's exactly when these imbalances are published. Actually, what's interesting is that this data actually starts building as early as 2 p.m. Eastern. And you could actually see the market was trading lower most of that time. Perhaps there were some indications that there would be a bigger sell imbalance going into the end of the day. But market clearly caught off guard because we got that big end of day rally. So I think Friday's trading action really is more of a reflection of options expiration and of course the end of day buy imbalance, which there's really nothing you can do about that. It's all mechanical, and the market's just going to gyrate and move to where those things are going to push it. And unfortunately, I think you're going to see some of that this week as well. Let's look at the optioncharts.io setup for this week, at least through the 31st, rather. What stands out, obviously, is this 55.65 strike price, which is that JP Morgan collar, you remember they put up the three legs, and this is where the put, I believe, lives at 55.65. So that's right now potentially going to be one of the more dominant forces. I know a lot of people are looking for the market to move higher. This level could be a reason why the market doesn't move higher, and it could act as a magnet, sort of dragging the market back towards it as the week goes on, especially as we get closer to the 31st. The other thing, obviously, this week is we're going to get some data points that are going to potentially be actually market moving in some ways. S&P Global will come Monday morning. And before we go on, I need to remind everyone to please like this video, share it with your friends, and please help me grow the channel out in 2025. I was trying to make a goal to reach 50,000 followers this year. I don't know if we're going to get there or not at this pace, but certainly I really appreciate everyone that watches. And again, just remember to like the video so we can try to get more views and continue to grow. The first thing Monday morning, basically 9:45. So this is an important number. Markets responded strongly to these numbers in the past. This is sort of a first look at somehow some PMI data points are showing up. Only about 85% of the companies report in this data, but it's enough that we can start getting a sense of whether or not there was a pickup in services or manufacturing, or if there was a potential further slowdown. So the market could respond strongly to these data points. It could very well be an important data point. Then we're going to get Case-Shiller on the 25th. Then on the 26th, we'll get durable goods. On Thursday, the 27th, we're going to get GDP revisions. Of course, initial jobless claims. Initial jobless claims have really been kind of steady at this 225 region, but the continuing claims are continuing to kind of build and climb, and that's not unexpected given that you've seen jolts, the job openings really declining, and you would expect with fewer job openings, it's going to take longer for people to find jobs, and that's why you're seeing this continuing claims number continue to build. And then, of course, we're going to be getting Kansas City Fed manufacturing. This is going to be an important data point just from the standpoint of paying attention to prices paid. Prices paid, obviously, are a big component. Input costs, inflationary. Last week we got Philly Fed. Last week we got Empire State. Both showed a further acceleration in prices paid. Kansas City Fed, this will be an important input on that. And then, of course, we're going to be getting on Friday morning PCE. Core is expected to come in at 0.3% month over month. Year over year, 2.7. Month over month, high headline index 0.3. Year over year, 2.5. And then we're going to get the University of Michigan numbers also becoming a little bit more important. This was a a big lower number. We got these really large inflation expectation numbers that were finals. If you listen to the Fed speakers, they're kind of labeling this as a bit of an outlier. I'm not really sure that it's an outlier, but we'll see how the data comes in this week. And the one thing that is interesting is if you go to Kalshi's website, again, this is all public. If you go to their website and you look, you can see that core PCE is actually pricing on their website at 0.4 in the betting markets. And I think that's interesting. I do pay attention to this, and I do like to see how this market is sort of lining up with other data points we're seeing. Unfortunately, I don't really have much of a look in terms of PCE, so that's something I do watch and I do pay attention to, and I always pay attention, especially when the number diverges from what analysts' expectations are. So the other thing, obviously, is that we've seen the VIX move back down to around 19. This has obviously been an area where we've been holding now after VIX Op X. 19 is a fairly important number. We'll have to pay attention to whether or not they can actually get the VIX lower. This 18.5 area has been kind of an important region. At least this time it acted as support. Here you can see it acted as resistance, it acted as support, acted as resistance, 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 and now we'll see if it can manage to hold for support. The other thing on Friday, which I thought was interesting, 1 month implied correlations have really been stabilizing the last couple of trading sessions. This typically trades inverse to the S&P 500, and so if this kind of flattens out and we don't really see it going down more, or the pace of it going down slows, or it actually reverses and starts going higher, that would be a warning sign that the rallies we're seeing in the S&P are not probably something that are going to stick for very long. The other thing is we have seen credit spreads really now starting to move up. This is the high yield. This is the market CDX high yield credit spread. This is the 5-year Japanese cross-currency basis swap spread, and really hasn't done very much more recently, kind of again indicating that we're not really seeing any sort of material change here. Also, when we look at the Euro 5-year cross-currency basis swap spread, that's also showing you really not much of a change. And so again, these are important spreads to keep an eye on if you can, because they can give you a sense of where credit spreads are likely to go overall, whether or not the market is the S&P 500 is sort of moving counter to what those spreads are saying. Obviously, and you can see that the RSP had a much weaker day on the day, finishing down 46 basis points, which again sort of tells you that a lot of what you were seeing in the S&P on Friday likely had to do with option expiration. And when you HGX, the housing index, that's actually at a really critical level right now. You can see that we're kind of hanging in around this 641 region. If you really start breaking this area, you can really start making a case for a much bigger drop, possibly even going all the way back to where we were, call it in July of 23. So this is again, an important sector. I tend to pay attention to it just because the S&P can tend to track with this index over the time, and sometimes the index will actually act as a little bit of a leading indicator. For example, in 2018 was declining pretty sharply all year while the S&P was moving up. Eventually, they caught up with each other. Even in 2023, right, which is something that I totally missed, is that you saw the HGX really rocket higher in this from this November to December period, and then the S&P eventually caught up, and even now, so you saw that this started really weakening well before this started weakening. So I would really keep a close eye on this and just kind of see how this plays out. If it continues to weaken, which I'm thinking maybe it can, just because obviously we have mortgage rates which are still high, relatively speaking. When we look at the price of lumber, that's really been moving up. That's obviously a main input price. And then, of course, we've seen copper prices also moving up sharply more recently as well. So there's just a lot of different nuances that could potentially weigh on that. When we look at currencies, USD, JPY, a little bit weaker on Friday. We'll find out how much of this has to do with positioning. Basically, the BOJ, it looks like, based on the inflation data we got the other day out of Japan, the BOJ is probably going to have to continue raising rates. The pace at which they do it, of course, goes into question. But I find it hard to believe that you're going to see material weakening from the yen on an ongoing basis, given the directions of monetary policy over there versus over here in the U.S. So I would again think that over time you're going to see the yen continue to strengthen versus the dollar. Doesn't mean it happens in a straight line. And even when you look at the euro, that's kind of backed off a little bit more recently. But again, it was really overbought. So we'll keep an eye on this as well. Anyway, I hope you found this helpful. Please remember to subscribe to this channel, like this video, share it with your friends.